In the video today, we will be discussing investing. What are the different approaches to investing and how can you make more than the market average when investing? Those are huge questions that people want to understand. The way that you get rich nowadays is investing your money. Inflation is so high that your savings accounts are actually losing you money. Again, I'm not saying don't save money. You should always have an emergency fund, but investing is the way to get rich over time without having to put in a lot of work. So again, I'm going to discuss the biggest strategies that are used worldwide to invest. The first one is value investing. Value investing is going to be finding hot sectors such as AI, fintech, finance, and technology. All these different categories, one being cannabis. That was one of the hugest, hottest sectors. It doesn't even have to be a hot sector. It's a company, an up-and-coming company that you believe has great fundamentals. That means it has great cash flows. It's having a lot of sales. The guidance and the vision for the business is where it should be, right? You're investing because you think this stock has more value than the actual stock price right now. So for instance, it's like someone seeing value in buying a cannabis stock, CGC, back in 2016, right? It would be here around $3.12. Well, now it's up here around, $30, right? So that's up 10 times your money. So that's incredible. That is known as value investing. But again, the risky part with value investing is that you never know where it's actually going to go. This company could actually be worthless, and the way that you're analyzing the stock, you have to make sure it's purely fundamental because you don't care what's going to happen. You don't care about stop losses, right? You don't care if it drops down 50%. You're in it for the long run. So that's where your capital is tied up. So you can't always have the exact money you need to trade those great trades. And anyways, moving on. Second investing approach is dividend investing. One that we can look at here is McDonald's. McDonald's is giving around a 3% dividend rate every year, right? So again, you can see that there's multiple dividends throughout the year, quarterly dividends. They divide the 3% up 4 different times throughout the year. So you can see here that you're making money through the appreciation of the stock. The stock is going up, so your money is increasing as it's in it, and you're also receiving dividends from the company. So that's an awesome thing. However, the caveat with dividends is people who buy dividends for the pure sake of buying dividends. So you have McDonald's here, which is offering a dividend and appreciating in value. That's what you want to buy, right? So your money is increasing in value, and the money that's making, the dividend percentage off the money that is making is growing. So your dividend, you're getting money from dividends. That money is growing because your money is growing. I know that makes a lot of weird sounds and noises, whatever, in your head, but understand it's best to invest in a dividend stock that is going up. But some people, on the other hand, like APBV, a lot of the dividend stocks that offer a huge dividend yield actually are downtrending. You can see here are actually moving down. What does that mean? It means if you invest $100, if you invest in 100 shares here at $95, that would be $9,500. Well, currently the stock is at $64. So that means your then $9,500 is now worth $6,400. But you bought it because of a dividend, right? So again, I don't know where the dividend is exactly on this. I wish I would have researched that before. My bad. But let's say it's at a 3% dividend rate. Okay, if you bought it here at around the 95 because you wanted, or even worse at the top, right? But let's say you bought it here at $95 purely for the dividend. The stock so far has dropped negative 35%. So even though you gained, let's say over the 2 years, it's really only like one and a half. Let's say you gained that 3% each year. So let's say you gained 6% from the stock, but the stock also lost negative 35%. So that means now your net negative 29%. So your money, that money you invested, let's say you invested $10,000, you now lost that much money. You lost $2,900 purely because you thought it was good to buy dividend. So that's the one caveat of dividend stocks. Make sure it's trending to the upside. Now, the last approach I want to talk about is my approach to investing. I take all my day trading profits and other side business profits and it goes into investing. The investing for that is what I call a market directional investing approach. Now again, I have my own programming algorithm that I made for it, but since I made it, I would not like to release it at this time. At least I'm still working on it, still developing it. But you can see here that if you want to invest in dividend stocks, the best way to do it is when the stock is appreciating. So to give you a rough analysis of this, you can use a 200-day moving average. If you don't know what that is, you go into your indicators, you select daily SMA, you select 200, and you get this line. So everything above this line is known to be bullish on the market. Everything below that line is known to be bearish. So if you invest in dividend stocks when they are above this, you're capitalizing on the appreciation value, so making around 66% on your money just from the stock appreciating, but you're also holding it over this year and collecting that 3% dividend. For example, let's go back to MCD, which is McDonald's. See here, if you invest when it starts to go up and then you sell off here, you would have made 35% from the appreciation of the stock, in addition to the around 3% dividend that it offers. So now you're looking at around 38%, right? That's incredible. That's the way you want to invest in dividend stocks. If it's under that 200-day moving average, you're looking at more of a bearish approach. You don't necessarily want that. Your money's going to be losing value. So, for instance, if we go back here to ABBV, I know we just looked at this, but you would not invest in it under $100 because you know that since it's bearish, it's underneath this 200-day moving average, you're going to see that move down. So, again, what I'm trying to show people through the Instagram account, which is linked below, free investing content, and this YouTube channel, is that you can pick a market directional approach. You can, without having to time the market, you don't have to know. You're just looking and understanding, is it bearish or bullish, and you can hugely increase your profits just by knowing when to get in the market. All right, guys, that is investing 101, value investing, dividend investing, market directional investing. Again, there's also buy and hold, but everyone knows about that, so I didn't necessarily want to cover it in this video. Buy and hold is where you buy the stock and you just hold forever no matter what it is. It's usually in indexes like the SPY, where it tracks the market. All right, guys, thank you so much for watching. Please subscribe, turn on the alerts, and comment so I know what other videos you would like to see, as I love making videos and content that you want to see. All right, guys, see you in the next video.